Good morning. Welcome to the Streets opening bell here from Post 35 on the floor of the New York Stock Exchange. It's Monday, September 26th. I'm Sara Silverstein filling in for JD Durkin. The opening bell rung a few moments ago by executives and guests of Comstock Resources in celebration of its 25th anniversary on the exchange. Jerry Jones is here. Yes, that Jerry Jones, ringing the bell as a majority stakeholder in Comstock. Quick check of the big board a few minutes into this trading Monday. I'm seeing a lot of red for the Dow Jones. The VIX, of course, higher in contrast. Here's what's on tap this morning. Starting out this Monday morning with fresh housing data, currency markets in turmoil, and getting ready for a big week ahead. In order to figure that out, we need to bring in our senior editor and markets correspondent, Martin Baccardax. Martin, are you there?
I am indeed, Sarah. Looking at the red this morning to start the day, I mean, it's not as bad as it was a couple of hours ago. I was looking at some pre-market activity that suggested we would drop as much as 250 points. We seem to have stabilized a bit. Bond yields have stabilized as well. But it's that currency market turmoil that we can't take our eyes off, isn't it? I mean, we are looking at 20-year highs for the US dollar index. That's really the best way that we can benchmark the greenback against a basket of its global peers, and that's being driven for the most part by the anticipation of new Fed rate hikes. The CME Group's Fed Watch tells us there's about a 77% chance of another 75 basis point rate hike when the Fed meets in November. That would be the fourth in succession and would really cap what we're really now seeing as the most aggressive Fed tightening in at least a generation when you put it in context with the selling of bonds from the Fed's balance sheet. So the fact that we're seeing such a flight in terms of rate hike anticipation, we're seeing that reverberate into currency markets around the world. Most of the central banks are playing catch up or indeed having to be dovish in order to stimulate growth in their economies as recession possibly looms. So as a result, we're seeing depressed currency valuations in Japan, in China, in Europe, and in the United Kingdom. And Sarah, that's the most significant because the pound hit an all-time low against the US dollar this morning. That's something I would never have imagined to see in my lifetime. We're flirting with parity now, and there's talk of an emergency rate hike from the Bank of England in order to steady the ship.
And what happens if there is an emergency rate hike from the Bank of England? What happens to markets?
That's going to be an interesting question, Sarah, because ultimately we're in uncharted territory in some ways. We saw foreign exchange intervention last week from the Bank of Japan, and it had only a minimal impact. It was able to strengthen the yen just a little bit. It's odd that the Bank of Japan wants to strengthen the yen. It typically wants to weaken it. But because of the impact of inflation, they're finding imported energy prices are just far too expensive for the common people to bear. So they're trying to strengthen the yen as a result. But really, we're right back to levels that we were prior to the intervention, only 2 trading days afterwards. So the anticipation of a Bank of England rate hike, which could be as much as a full percent, in fact, money markets are pricing in 2% of increases between now and the end of the year, might not be lasting either. And that would be even more difficult to bear for the UK economy, which is, of course, is flirting with recession and is in the midst of what is possibly an energy crisis as a result of surging oil and gas prices around the region, linked in part to Russia's war on Ukraine. So there are so many moving parts to the story, we can't perfectly anticipate what might happen. But the one thing that we can be certain of, Sarah, is that if the Bank of England were to intervene now, it might be seen to have lost its political independence from the government. And this government is only 3 weeks old and is struggling to maintain popularity in the face of what would normally be quite a popular decision to cut taxes. But because we've seen such a decline in the pound, people are questioning the economic validity of some of their choices. And if the Bank of England were to rescue them from that, they would see that as losing political independence.
And for those of us who aren't trading currency, how does this impact the markets? Is it mostly tied to how the central banks react, or are there other ways that it impacts the markets?
I think there's a few ways that we can look at it, Sarah. Ultimately, the central bank reaction function is probably the most important for people in markets in terms of a professional aspect. But for the rest of us who are sort of looking at it from the outside, either as an investor, an observer, or really just an everyday consumer in the U.S. economy, the biggest impact is going to be the increase in the U.S. dollar. As I mentioned, we're trading at the highest levels in more than 20 years against a basket of our global peers. That has both good and bad aspects. The good, from a consumer point of view, is that imported goods become increasingly cheaper. That's going to be excellent news heading into the holiday season, where the bulk of the consumer products that we buy are imported or made by American companies in overseas markets. We're also probably going to see, as a result, imported energy get cheaper as well. And that's going to be excellent news given the fact that the economy has been resilient, thanks in part to that big decline over the summertime in gas prices. And gas prices now are just bumping a little bit higher. We're into the hurricane season. Oil prices were nudging a little bit higher last week. And ultimately, if the dollar were to strengthen, those gas prices would probably retreat into the winter months as well. So there's a couple of good benefits from the consumer point of view. The difficulty from the corporate point of view, Sara, in the United States, is that about 40% of S&P 500 revenues come from overseas markets. Repatriating those as the dollar increases becomes more expensive and acts as a headwind on corporate earnings. We have all sorts of companies telling us that, Microsoft being the most specific, but many others as well. So we need some earnings growth alongside consumer growth to ensure that we don't slip into recession here in the US, and a strong dollar doesn't necessarily help that, at least from the corporate point of view.
Great. And Martin, set us up for this week. What are you looking for in terms of economic data and earnings?
I think the most important thing that I'm looking for this week is not until Friday, unfortunately, but it's the PCE price index. That, Sara, is the Fed's preferred measure of inflation. It strips away some of the vagaries that you might see in a headline CPI reading, and it is designed to give a more blended and accurate look at the way people are spending in the economy as their spending habits change as a result of the way that products enter and leave the marketplace. So the PCE core price index is what the Fed pays the most attention to, and we'll get an August reading for that on Friday morning. Now, the reason that is important, of course, is because headline inflation for the month of August accelerated unexpectedly. We're now at 8.3% when the anticipation was for it to slide. And we do need inflation to decelerate in the coming months in order to ensure that we're able to avoid recession here in the US economy. So that Friday reading is critical. There'll be Fed speakers in the field on Friday afternoon, shortly after the data. And of course, we're all going to be listening to them with respect to how they see the reading, what they anticipate their forecasts will be in terms of change as a result of it, and therefore what we can anticipate for rate hikes in November and beyond. We're going to get a speech from Jay Powell tomorrow at 7:30 a.m. Eastern Time. It may not have much detail. It's meant to be just opening remarks in a banking research conference in St. Louis. But nonetheless, the fact that he is speaking so shortly after that rate hike from last week will demand attention from investors and the marketplace, and absolutely have sort of influence on what we see in pre-market and opening market trading tomorrow. I'm ultimately also looking, Sara, at the housing market. We're going to get new and pending home sales data on Tuesday and Wednesday of this week. I think those are going to be very interesting given the fact that we saw mortgage rates climb past 6% for the first time since 2008, 2 weeks ago. They're now at, I think, about 6.25%, depending on who you take the measurement from, and that's for a 30-year fixed. They're only going to go higher if we're anticipating further Fed rate hikes. That's only going to depress house prices, not only at an existing level, but at a pending level, and in different cities around the world, around the country, as well as borrowing costs increase. And the labor issues and the lumber issues that we've seen percolate for most of the year are also holding back new inventory in the housing market. So ultimately, we're going to see some difficulty there for sure. And then one thing as well, Sara, that I'm looking at, which a little bit pointy-headed, but I think could be important, is a 2-year bond auction later this afternoon. The Treasury is going to sell about $43 billion in new 2-year notes. That will be interesting because, of course, we're at the highest levels for 2-year notes since 2007. We're trading at around 4.25%. And that is well ahead of the S&P 500 dividend yield. In put another way, if you were to go into short-term Treasury bonds, you are guaranteed a rate of return that is significantly higher than putting your money into the riskier equity markets. Now, that rate doesn't stay the same for the whole of the investment, but at the moment, it looks pretty attractive. So we'll be interested to see what kind of institutional demand we'll get for this afternoon's auctions, because that might suggest that more and more investors are trying to plow money out of equities and into the safer regions of the fixed income markets. And of course, that's not going to have positive implications for stocks heading into the end of the year.
And it looks like the market is slightly down this morning, but the tech stocks are slightly up or
Yeah.
more flat to slightly up. What's happening there?
I'm surprised by that actually, but maybe it really is just a bit of bargain hunting. The Nasdaq fell 5% last week on top of a 5% decline the week before, and it suffered the most year to date when compared to the other indices. So I do wonder if the slight pullback that we're seeing in treasury bond yields is eliciting some bargain hunting, and the fact that we've just might be a little bit oversold is also a reason that investors are coming in underneath. And maybe, just maybe, you could argue that the tech stocks are going to lead the economy out of a recession if it is indeed a shallow one, because most economists say that at the aggregate level, consumer balance sheets, in other words, the money that we all have close at hand, either in cash or in marketable securities, is at about 3.3 trillion across the US economy. That, alongside corporate balance sheet strength, represents about 14% of GDP, Sarah. So it gives the economy significant resilience, and you'd like to think that tech, which was the leader on the way down, could be the leader on the way out as well. Maybe you're just finding some people getting in and getting some cheap stock prices this morning as a result. But I would put that more down to the slight pullback in yields than any long-term interpretation about what's going to happen with stocks in the tech space, because I still think it's an interest rate story, and that interest rate story is still rising.
And what about gas prices? What are you looking for gas prices to do this week?
They nudged up a couple of pennies last night, Sarah, which kind of surprised me. They're at about 3.72, I think, if memory serves, from data that I saw on the AAA website this morning. They'd been declining for about 14 or 15 weeks and only nudged higher the past few days. There's a change in blend that goes into the gas stations around the country from a summer blend to a winter blend. It's a little bit pointy-headed, but essentially what it means is that you have to pay more for gas in the summertime in order to keep emissions down. Refiners find that a more expensive blend to produce. But the winter blend is a little bit cheaper, but the transition sometimes nudges gas price higher. So as we head into the winter months, gas prices are likely to get a little bit cheaper, because I would imagine a couple of things are going to happen. Firstly, the US dollar is going to continue to strengthen. That's going to put downward pressure on oil prices. And we're also just going to see bets on really reduced demand for energy across the entire complex, which is going to push energy prices down, and indeed oil prices down as well. We're seeing that in copper, seeing it across the metal space, and indeed in oil again this morning. So those collective dynamics will probably keep gas prices on a downward trend into November and beyond.
Great. Now it's time for our rapid fire section. Martin, get ready. Here's the first question.
Let's do it.
What can we expect from Elon Musk's Twitter deposition?
I think we can expect leaks, Sarah, to be perfectly honest. This is not meant to be a public deposition. Elon Musk, of course, is in the throes of a months-long legal battle with Twitter over whether he wants to ultimately purchase this company. He, of course, does not, but he said he was going to for about $44 billion. Now, he is going to be questioned by Twitter's lawyers over the coming days, today and tomorrow, possibly into Wednesday, in what should be what's called an in-camera session. In other words, it's meant to be private, but we know it's not going to remain so. And he is a combative witness. So I'll be interested to see what comes out of these discussions, and that might give us a hint as to what his tactic might be when he goes to the Delaware court on the 17th of October to ultimately challenge his previous pledge to buy the company. He essentially says, listen, you guys haven't been honest about the number of bot accounts on the platform. There are other transparency issues as well that I'm not comfortable with, and that represents a material breach in my promise to purchase the company. Twitter says, absolutely not. We've been upfront with you from the start. You owe us $54.20 per share. Markets seem to be edging more towards Twitter's side of the argument right now, but the deposition today, and obviously the case in October, will tell us what's going to happen.
Amazon is planning a Prime early access event. Is this a new race to reel in holiday shoppers?
It feels like that, Sarah. Last week, Target said it was going to bring forward its holiday season discounts by about a week and stretch the period in which it offers sort of price matching from October all the way into the end of the Christmas holidays, which was a little bit of a surprise to markets and suggests that companies want to make sure that they capture value hunting shoppers as early as they possibly can. So it was interesting to me to see Amazon follow suit. They're going to have something called Prime Access Day for its Prime member customers. It's going to begin on October the 11th. It's going to last for 2 days with some other sort of specials and discounts heading into the Christmas period as well. It won't be as big as Prime Day, but it's a mini event nonetheless that's likely to capture a lot of attention and does suggest that people are worried about ultimately where consumer spending is going to be come November, December, and they feel that it might be best to capture it now before there's more questions over consumer strength as we head closer to the Christmas holidays.
Great. Up next, should Gulf oil drillers be concerned about Hurricane Ian?
I was looking at that this morning, actually, Sarah, on the National Hurricane Center website, which I encourage lots of people to go and check out because the detail is absolutely extraordinary. And even for a layman like myself, it's very easy to understand. But the expanded cone of concern, as they describe it, which is essentially the breadth of this Hurricane Ian, is a lot wider than I think people had first anticipated. And it's nudging near the west Gulf Coast of Florida, but it's wide enough that it's actually starting to worry drillers in the Gulf region, perhaps into the panhandle of Florida and ultimately into the southern part of Louisiana. Now, there's lots of change that can happen over the next 24 to 48 hours, but the hurricane itself is carrying sustained winds of about 75 kilometers per hour. There's tropical storm watches along the coast of Florida and indeed further north, Tampa and beyond. And at this point, there hasn't been any evacuation that I have read about for Gulf drillers. But if there is, that could be the one caveat to my anticipation of lower gas prices going forward, because if we get a disruption in supply, ultimately that's going to filter through into demand. So oil people are going to be watching this very closely, as the rest of us are, just from the human perspective of what we can only hope is going to be a mild and at-sea hurricane over the coming days.
Absolutely. And finally, are McDonald's newest price hikes an impact of the surging dollar?
It feels like that, Sarah, doesn't it? I was really astonished to see this this morning. McDonald's in Japan is going to raise prices on about 60% of its menu items across the country. It's worth noting that the yen is trading at about a 24-year low against the US dollar. So import costs for any company doing business there are pretty significant, and McDonald's feels it has the pricing power to pass that along to customers. But what was also interesting, Sarah, was how cheap a Big Mac is in Japan. They are increasing the price by about 5 to 7%, but a Big Mac is only going to cost the equivalent of about $2.85 American dollars. Around the United States, the average cost of a Big Mac is about $5.15. So there's a lot more room to go, it would seem, for Japanese customers, or maybe they're just not that excited about a burger and they prefer something that's a little bit more home cooked. Hard to say, but I would imagine that a lot of American companies doing business overseas where currencies are collapsing, in Britain, in Europe, where the euro is trading at a 20-year low against the dollar, Japan and elsewhere, are going to be contemplating price hikes. Apple did not with the launch of its iPhone 14 a couple of weeks ago, and that surprised a lot of people. I do wonder how long they're going to be able to keep that up, however.
The brilliant Martin Baccardax, thank you so much.
Thank you, Sarah.
That'll do it from the opening bell here from the floor of the New York Stock Exchange. Stick with The Street and Martin for more on these and every other major market story.